Hi, everyone. Welcome to this wealthmanagement.com Fast Chat. I'm David Armstrong. Today, we're speaking to Peter Higgins, head of fixed income and a senior portfolio manager at Shelton Capital Management. Peter, thanks for joining us.
Thanks for having me again, David. Happy summer to you.
Happy summer to you. Since the last time we spoke here, we seem to have kind of come full circle since early March, I think was the last time we did this. How did the market make this round trip? And what do you see as the results based on the data? Is there some kind of dislocation here?
It is pretty much data driven, to be honest. You are right. We have had quite a ride and we have come full circle. I think the week before we first spoke in early March, the 10-year treasury was hovering around 4%. Last week, it was also hovering around 4%, but we're 50 basis points off the lows today. So it is the data that's driving it. I think there's a couple things. The market had been trying to fight the Fed, and fighting the Fed has proven to be a bit of a losing battle. The market's finally realizing that rates will remain higher for longer, as the Fed has been telegraphed. So we agree with that, and that's kind of how we've been positioned all year long. Now, where we've been surprised on our fixed income franchise is the fact that the economy has been more resilient. So we thought that the ongoing credit contraction accelerated post Silicon Valley Bank, and it has, but it's not derailing the economy yet. It could take time to transmit, but right now the economic data is definitely more supportive of growth than we would have expected, and the consumer is leading the charge, spending their money on services. I think one of the key stats we like to look at is the Atlanta Fed's GDP Now indicator, and that's forecasting growth, GDP growth at 2.3%. So growth is still intact, and the rates are staying higher because of it. So it's a fair outcome, even if we didn't necessarily predict it.
Yeah, you say as of yet, is this growth sustainable? What does it mean for bonds, for instance?
Sure. I mean, simply put, in our opinion, it's not sustainable. It's highly unlikely that the growth continues, and there's a couple of reasons. One, the Fed isn't done, right? Their playbook is well telegraphed at this point. They paused. They're going to raise rates 25 basis points again in July. They're likely to pause again and look at more data as it comes in, and then maybe raise a second time if you believe their dot plots. So there's a little bit of a disconnect going on with the market again, because the market is pricing in that July hike, but only about 25-30% of the market participants are pricing in that second hike. So it will be data dependent as we get there. And I think one of the key things we're focused on going forward is that we know manufacturing has been weak, I think, for 8 months now. Selected parts of the service economy are slowing down, but there's still growth in services, which is obviously the lion's share of our GDP. But one fact is relatively new. The student debt pile is resuming repayments, and that's going to impact a lot of discretionary spending of money people thought they had in their pockets the last couple of years during the moratorium, but now that is going to repay the interest on those student loans and principals on those student loans. So I think that's going to, slow down the consumer, which has been the engine behind the economy.
Yeah. Go ahead. Sorry.
I was just going to say, I guess, listening to myself speak, there's probably two thoughts. One is, well, can yields still go up, and when will yields go down? And I guess the point on going up is that there is that disconnect still between the market not necessarily pricing in that second hike. So if that second hike comes, or once the market believes that second hike comes, you can see yields going a little higher. But, I said this last time, and I'll say it again, we're definitively more closer to the end of the hike cycle than the beginning. Simple math tells you after 500 basis points of movement, that would probably be the case. But I think it's prudent to start positioning for the end now. And, what's happening here is that you've got the Fed that's fixated on taming inflation first and foremost. The CPI numbers last week, the PPI numbers last week show a declining trend. That's good for the Fed, good for the markets. Employment, however, is still very strong. That's good for growth. So the Fed is kind of stuck in this situation where they need to fight inflation, but if there is still growth, maybe those inflationary numbers will stall before the ultimate 2% targets are hit. I think that mechanism is going to take a long time, and the markets come around sort of realizing that, hey, there won't be any yield cuts until spring of 24. And I think that the Fed will clearly be data dependent, but I can see that being stretched out even longer in 2024. But that's not the worst thing, because you're getting an attractive yield in today's environment. T-bills, which we spoke about last time, they have reinvestment risk, but they are, hovering. The 6-month is hovering about 5.5% right now. And then the 10-year treasury is down to about 3.8%. You get the added benefit of duration when you go out on the longer maturities. So what we've been trying to do is position for the ultimate fall in yields and slow down the economy that will drive government bond prices higher and capture that capital price appreciation.
Understood. Clearly, the equity markets also like the economic data. I think we have indices kind of hovering near 15-month highs, and some cases all-time high. Does that translate over to the corporate bond market, or how is the equity market strength impacting corporate credit markets?
Corporate spreads historically have been correlated to volatility. And right now, the VIX is pretty much at its recent lows. Equities are being led by the Magnificent Seven. The equities markets always love a good story, and they've got the AI thing to embrace right now. So you've got the S&P up about 18%, but on an equal weighted basis, it's a little bit more balanced. It's only up 8%. But the bottom line here is when corporate credit spreads are correlated to the equity market movements and volatility, with equities being up, volatility being low, there's no real catalyst for credit spreads to widen. And if our thesis plays out and the economy does slow, you would expect to see, equity markets come off a little bit here and credit spreads widen, but not just yet.
Got it. Where does that leave us today then? What are some of the yields on some of the indices that you follow?
Sure. The primary ones we follow are the municipal bond index, which on the surface is about 3.5%. But remember, if you are a high tax earner, the taxable equivalent yield could be closer to 6% on municipal bonds, which is pretty darn attractive in our opinion. Investment grade bonds are about 5.5% right now, and high yield bonds are about 8.25%. I think the last time we spoke, they were closer to 9%. So it's come in quite a bit.
Can advisors' clients actually buy those assets at those yields?
No, actually. When you break down the index, it's really difficult to buy the index because you have to buy all the components of that index first. And right now, the last time I checked, about 11% of the high yield bond index, for example, was trading at yield to worst levels within 10% of the index average. So what that means is there's a huge range of dispersion. And I guess what this kind of brings up is the question that really highlights the differences between active and passive management. And I think this might help your audience. Clearly, a lot of financial advisors and investors out there do invest a bit more passively into fixed income. And using high yield as an example, what I would share with you is that the one of the leading ETFs for high yield is the HYG ticker. And if you look at the indicated dividend yield of that ETF, it's about 6.5%. That's 180 basis points lower than the overall high yield bond index. And then when you kind of look at the returns on my screens here, year to date, you've got that HYG up about 5.7%, which is about 75 basis points lower than the Bloomberg high yield bond index. So you could even take it down a further still. We have some charts that show the 22 index sectors and only 4 of them are within spitting distance of the year-to-date return. So there's a lot of dispersion out there, and it's just not possible to buy the index, as clever as that might sound.
Yeah, yeah. You've made it clear that we're approaching the end of the Fed's rate hiking cycle here. Previously, we talked about how the market technicals and the fundamentals kind of impacted an investor's entry price. What's going on now, and what does that mean? What is the optimal timing for an investor? What's a good strategy for our audience?
Sure. Well, I'll touch on 2 things, I guess. One is the fundamentals, and hopefully some of my previous examples highlighting the need for active management makes sense. There's a lot of noise, as you even alluded to, around the global economies. So it is pretty apparent to us that now it's as important as ever to hire active managers, those managers that can parse through the fundamental credit analysis and figure out which bond at 6% is good, which bond at 10% is good, so that you get closer to that index average, because that 6 and that 10 are going to look a lot and smell a lot differently from one another. So the fundamental answer is kind of goes hand in hand with the active management statements I made previously. And then turning to technicals, what I would say is understanding market history is actually useful for predicting the future. And I'll share one stat with you that I like quoting from JP Morgan high yield research. For the month of the Fed's last rate hike over the last 5 cycles, high yield forward performance has been very attractive. So the next 12-month return after that last hike is over 12%. And even the next 3-month return is just over 5%. And if we bring that statement back to kind of our previous conversation about treasury bills and reinvestment risk, you could buy a 3-month T-bill today at 5.39%, or you can lock in, a high yield and potentially get that historical return over the next 3 months of 5% and not have that reinvestment risk. You already own it. You've locked in the duration. You've locked in the current yield. And if rates do move lower, you're going to participate from the capital price appreciation. So it's a good time to be investing right now. And, one other statement I remember making, and I think in our first call was, hey, it's better to be better to be early than late when investing in the fixed income markets. That power of the coupon is very strong. And with elevated yields today, you get paid to wait for what we think will ultimately decline in overall market yields. And as a result, an increase in capital prices.
Yeah, excellent. Finally, how should advisors and their clients think about appropriate weightings across the various fixed income products when they're putting together their fixed income portfolios?
Sure. I think a lot of advisors, when they talk about fixed income, they would usually refer to core fixed income, which would mean those funds that are benchmarked against the Bloomberg Ag Index. Some advisors maybe stretch it out to be more of a core plus type of investment. That would be the Ag plus another product. Typically, it's high yield bonds. At Shelton, we think that in this uncertain market and in this uncertain world that we're living in, flexibility is key. So we have our fund that is known as the Tactical Credit Fund, which it does do as advertised on the tin. It's tactical, it's flexible across all fixed income products, and gives us the opportunity to find risk-adjusted returns in spaces quite quickly because the markets do move fast. So, we've done some analysis, and I think at the end of the day, there's a great opportunity to, add a second or a third component to an overall fixed income portfolio that does potentially enhance the risk metrics while providing good total return opportunities across other fixed income products. So that's one thing we've been advising clients. The other is I'll sound like a broken record. It's, if you're in the highest tax bracket as an investor, you can get potentially 6% taxable equivalent yields on buying municipal bonds. I think setting up an SMA that either has a 5 or 10 year target, or if you want to do the laddered strategy where you're getting roll down effects every 1, 2, 3, 4, 5 years is smart to lock in these current yields in this environment. So I think those two strategies, work. And, it takes a little bit of broadening your thinking when it comes to fixed income, that there's not just one or two products, but there are a lot of products that at certain points in the cycle offer different reward and risk levels that we try to take advantage of.
Yeah, it makes sense. The thing not to do is to let the broad aggregate index decide your weightings for you.
That would be true. I mean, listen, even in core fixed income, you can be a passive investor and just stick to the splits between U.S. Treasuries, between corporate bonds, investment grade corporate bonds, and securitized credit. But in reality, you can, an active investor or an active manager can take advantage of that asset allocation or the overall duration of the portfolio to create alpha. So, our strategy works for the tactical credit fund that is a bit broader on fixed income products, but active management also works for just your core plain vanilla ag exposure as well.
100%. Okay. Peter Higgins, head of fixed income, senior portfolio manager with Shelton Capital Management. Thank you very much.
All right. Thanks a lot, David. Appreciate it.